How banking crises impact the precious metal. Market banking crises often create widespread uncertainty in financial markets. When banks collapse or liquidity tightens, investors typically seek safe havens. Precious metals, especially gold and silver, are among the first assets to benefit. But the impact is not one-dimensional. It involves psychology, liquidity flows, and long-term positioning. Flight to safety. During a banking crisis, fear drives investors away from riskier assets like equities and into traditional safe havens. Gold, with its history as a store of value, often rallies sharply in such times. For example, during the 2008 global financial crisis, gold surged as banking institutions failed, reflecting a massive flight to safety, liquidity crunch, and forced selling. Ironically, crises can also cause temporary weakness in precious metals. When investors face margin calls or liquidity shortages, they often sell gold and silver to raise cash. This explains why precious metals sometimes dip at the very onset of a banking panic, before resuming their upward trajectory as panic buying takes over. Inflation, hedge versus deflation risk. Banking crises often prompt central banks to inject liquidity into the economy through quantitative easing and interest rate cuts. Such measures raise inflation expectations, which in turn boosts demand for precious metals as inflation hedges. However, in extreme deflationary shocks, the demand for metals can be subdued until stimulus measures take effect. Long-term investor confidence beyond immediate price swings. Banking crises reinforce the role of precious metals as long-term wealth preservers. Institutional investors, central banks, and individuals often increase allocations to gold reserves after crises to protect against systemic risk. Banking crises amplify both short-term volatility and long-term demand for precious metals. While initial panic may trigger some selling, the broader trend often favors gold and silver as trust in financial institutions declines. For traders and investors, recognizing these dynamics provides a powerful edge, helping them not only preserve wealth, but also profit from uncertainty.